If you bought a home with a mortgage between 2023 and currently 2025, you likely got a mortgage with a higher interest rate. Now, it's crazy to think about the fact that in 2020, the rates were as low as 2.5%. Now, do I think the rates will ever be that low again? Not for a while. But do I think the rates will decrease? Yes, and we'll likely see the rates hover around mid-5 to 6% in the long term. And when the rates do drop, you might consider refinancing your 7 or 8% interest rate down to, say, 5%. But I'm going to explain why you may want to think twice about doing this. In fact, some cases, refinancing could lead you to paying more interest even if you refinance to a lower rate. Now, I'm not saying not to refinance, I just want you to look at the numbers before you do. By the way, I'm Kwak, a certified financial education instructor, serial entrepreneur, and an investor. I've been helping thousands of homeowners save money and time when it comes to paying down their mortgage for nearly a decade. In this video, I'm going to unveil a rather alarming truth about why you won't always save money by refinancing to a lower rate. And more importantly, I'll show you how to think about refinancing in a way that could save you money. Now, if the mortgage rates haven't decreased when you're watching this months from the release, do bookmark and save this video as it will come in handy when the rates do drop. So with that said, I'm going to be using a calculator to visually illustrate when you could save money and when you won't by refinancing.
All right, friends. So to demonstrate whether refinancing would lead you to save money or not, I'm going to use an Excel spreadsheet to help demonstrate and visually illustrate in what scenarios and circumstances will you actually save money. So to do that, I have my loan amortization schedule spreadsheet that you can get for free on Microsoft Excel. It's a template that Microsoft provides, which is really nice, but I've modified it slightly to make it easier for us to compare what it looks like to refinance or not. So let's go and set the parameter as to our original loan that we currently have. And let's say we borrowed initially a $500,000 mortgage at 8% interest. Ouch, right? 30-year mortgage. And let's say we started this loan on January 1st of 2025. That would mean that our monthly principal and interest payment would be $3,668.82. And the total interest that we would pay at the end of the 30-year period is $820,776.23, which is more than the actual loan itself. It's almost 1.5 times the loan amount that we would have to pay for interest. So yeah, there's certainly motivation to see if we can refinance this down to a lower rate. So we have the amortization table and schedule here. You can see the amount of principal we would pay, the total payment, the amount of interest we're paying here as well, the ending balance, and the cumulative interest, meaning that's how much interest we paid up to a certain point. So each month, we're obviously making our monthly payment. So let's say on the 5th year of your mortgage, the rates drop to 5%. At this point, your ending balance is at $475,349. And up to this point, you paid approximately $195,000 of interest so far. So we got to take a quick time out here and ask ourselves, okay, is it worth refinancing at this point? Because we've already paid this much of interest. Is it worth it? So if we were to refinance that amount to a 5% interest mortgage, another 30-year refinance, this is what it could look like. So $475,000, okay, we're refinancing our outstanding balance. So here we are, we're refinancing our outstanding balance, 5% interest rate as opposed to 8%. Okay, and let's look at this from another 30-year perspective. Now, in a minute, I'm going to show you what it looks like to do a 25-year amortization, but let's just say we're going to take the 30-year option instead. Okay, so the date that we would refinance is on December 1st, 2029. So it's going to change that. There we go. Okay, our scheduled payment is $2,551.78. Already we can tell it looks way better. And the total interest we would pay across the next 30 years on this outstanding balance of $475,349.28 is approximately $443,209.70. So the idea is, okay, we've already paid about $190,000 of interest so far, and we have to pay another $443,000 with a 5% interest loan as opposed to 8%. So does that save us money? Well, let's take a look. Originally, we would have paid $820,000. We've already paid $195,000 so far, right? Being 5 years into the loan. If we refinance, we would be at $443,209 on a scheduled interest payments. So when we go from the original total interest minus the interest paid so far, minus the new refinance interest costs that we are going to pay, we would actually end up saving about $182,000 on total interest costs, which is good. On the cash flow side, meaning how much money of cash outlay can we save on a monthly basis, we were at $3,668.82 on the payment, but with the refinance, we are now at $2,551.78, saving us on the cash flow side of $1,117.05. So it's a win-win. We get to save interest in the long run, right? We're saving about $182,000 of interest across 30 years, but we also have an extra $1,100 of cash flow that we have available to us every single month. But what does it look like if we change that to a 25-year amortization as opposed to getting a brand new 30-year refinance? Let's take a look. So going back to the refinance, instead of taking a 30-year, let's go to 25. Okay, that certainly changes our total interest costs as well as the scheduled payments. So let's look at the final stats. All right, so you can see we can now save even more money at $266,993.49. On the cash flow side, we're saving a little less, right? But it's still nevertheless a savings from the original 30-year mortgage at 8% interest rate on our 30-year fixed rate. So I think we can safely conclude, given the parameters that we have, going from 8% interest rate mortgage down to a 5% will certainly save you a ton of money for sure. Now, when does it not make sense to save money? Let's take a look. So instead of an 8% loan that you start out with, let's say you start out with a 6% loan, so slightly less, okay? So you can see we're going to pay less of an interest cost over the next 30 years. And of course, we have a less of a scheduled payment every month. So if we start out with a 6% interest rate on the original loan, let's look at what it looks like on the 5th year. Okay, so in the 5th year, we paid down a little bit more, okay, $465,271.78 of outstanding balance, less on the cumulative interest as well. On the refinance, okay, we start out with the $465,000, which is where we left off right here on the 5th year, okay, and we are looking at a 30-year on a 5% interest rate, okay, slightly less than the scheduled payments, and total interest of $433,892.85. Final stats, here's what it looks like. Okay, so originally we were going to pay $579,190.95. We paid $145,136.94 already at this point. And the new refinance total interest would be $433,892.85. Now, surprisingly, at the end of the day, we're only going to be saving $161.15. Now, from my perspective and opinion, I don't think it's worth refinancing at this point because not only are you saving a very minuscule amount, but you're going to have to pay closing costs as well as go through the application process, which is going to be a lot of paperwork that you're going to have to shuffle. Now, where it could make sense is on the cash flow side. If you're looking for the extra $500 of cash flow savings, it could be worth it because you're going from $2,997.75 of original P&I payment down to just $2,497.68. Now, from that perspective, is it worth it? Maybe. Is $500 a month worth it for an extra, you might have to spend another $5,000 to $15,000 on closing costs, maybe more, depending on where you're at. And, really at the end of the day, is that worth it? And so really at that point, it's up to you to decide what's more important to you. Do you want to pay the extra $5,000 to $15,000 of closing costs to capture a $500 of cash flow saving every month? Is that worth it? And really doesn't translate into long-term interest savings at all. So at this point, my opinion, my perspective, if I were in this position, I probably won't. I would just continue with the loan already. But that's just what I think. And you might have a different priority as well as a different financial situation where that $500 a month may go a long way. You might use it to, pay down other debt. Maybe you have credit card debt that you want to pay down. Great. I mean, that might be a better solution in that scenario because now you're able to save more money on the credit card interest side, right? So again, it kind of puts into perspective, just because you go for a lower rate doesn't necessarily mean that you're going to end up saving more money. Now, things also change if you're further down the line in terms of your loan. So what if instead of refinancing on the 5th year, what if you refinance on the, let's say, 10th year? So let's go and take a look at the 120th payment. All right, so we're going to make some changes here. 120th payment, which will be 10 years. There we go. All right. Things are going to look slightly different. So at this point, all right, you've paid down. All right, let's take a look. All right. So at this point, you would have paid $278,158 of interest so far, right? And if you were to refinance the outstanding balance on your 10th year, it actually results in losing money of $89,176.89. That's because at the 10th year mark, you've essentially made almost half of all the interest payments you'll ever make on this loan, or at least the scheduled interest payments. So at that point, it really doesn't make sense because you're allowing the interest to accrue again over the next 30 years or additional 10 years at that point. So it's costing you more money, $89,000. Is it saving you some money on the cash flow side? Sure, but it's costing you $89,000 to do so. So again, my point of showing you all these different illustrations and situation is to show you that just because the interest rates go down doesn't automatically necessarily translate to savings. And it depends on the context of course, how far are you into the current mortgage, the interest rate spread, and so on. So at the end of the day, can you save money by refinancing? Sure, you certainly can, but not always. So when someone tells you to go refinance to a lower rate, always take it with a grain of salt because it all depends on the context, where you're at, and just know that you're not automatically going to save money all the time. Now, if you're someone that loves to save money and you want to pay off your mortgage faster, we actually have a different strategy called an accelerated payoff strategy where it doesn't necessarily involve refinancing, but simply by changing where you store your money, you could potentially pay off your mortgage in as early as 5 to 7 years and save up to 70% on your interest costs on your mortgage. So if you're intrigued by that idea and want to learn what that strategy might be, check out the link down below in the video description where I'm going to go and put a link to another YouTube video to explain what this strategy is and how it can help you save money and time with paying down your mortgage so that you can ultimately focus on putting all your money into investments or retirement and really focusing on things that matter in your life. So if you found this video to be helpful, be sure to share it with a friend that is thinking about refinancing or bookmark it for the future. We'll see you in the next video. Take care.